Hello. Hello.
हाँ सर।
Right. So can you see?
हाँ
Is my screen visible?
हाँ విజిబుల్ సార్.
Notes కనిపిస్తుందండి.
కనిపిస్తుంది సార్.
Okay. Okay. Right. So we'll discuss this valuation of fixed income securities today. Right. So how this valuation of fixed income of the fixed income security is different. Valuation, let it be equity, let it be fixed income securities, the underlying principle is same, where given the future cash flows and required rate of return, you're supposed to calculate the present value and compare this present value, what you have calculated with the value of that asset in the market. And explain whether it is undervalued or overvalued. Right? That's what we do in valuation. Let it be equity or fixed income. The underlying principle is same. But when we discuss about fixed income, how this fixed income is different from equity is in equity we get dividend and there will be capital gain for the stock. In fixed income, right? So we have two things here. In fixed income, we have preference shares and we have debt or bonds, right? So in these two fixed income securities, in a preference shares, we get preference dividend, right? Like equity shares, these instruments also pay the preference dividend. Bonds pay coupon, right? And why do we call them as fixed income securities? Generally, is the preference dividend in preference shares as well as the coupon in bonds both remain fixed for the life of the asset. Say suppose if a bond issuer promises to pay 10 percentage coupon on the face value, right? And if he promises yearly coupon payment, then every year you get 100 until the maturity of the bond. In the same way, preference dividend is also fixed. That's the reason why we call it as fixed income securities. Unlike in equity, you don't know when the company pay dividend, and even if the company pays the dividend regularly, you don't know how much the dividend could be. Sometimes the dividend could be 10 rupees, sometimes it could be 5, then it could be 12, like this. So this is not a fixed income, but preference shares as well as bonds, which are fixed income securities, the the preference dividend and the coupon payments both remain fixed for the life of the asset. So that's the reason why we call them as fixed income securities. So these fixed income securities, let it be equity, right? What we discussed yesterday, bonds, preference shares generally considered as long-term sources of funds. They are long-term sources of funds for a corporate, right? And right? So when it comes to preference shares, right, we call them as preferred shares. Preference shares are simply the preferred, right? These preferred shares will have the features in combination of, right, the common stock as well as the debt, right? So preferred shares generally have, we call them as hybrid assets or hybrid securities because they have the features of equity, right, and the features of bonds, right? What are the features of equity they have? We get dividend. That is the feature of equity, but we get dividend on preference shares. We call it as preference dividend. And what is the feature of uh, debt? The preference shares has the amount of dividend, unlike the amount of dividend on equity, the amount of dividend on preference shares is fixed. So that is the reason why. the preference shares or preferred stock is called as hybrid, right? In the sense that it consists of the characteristics or the properties of equity and bonds. And whenever, right, so you can see here the priority, right, at the time of insolvency, or if the company is unable to run the operations, right, the amount of money is first paid to the creditors who are the investors invested in the bonds or the debt instruments of the company. Then it comes to preference shareholders, right? And then if anything remain, it will go to equity shareholders. So what does it mean is the preferred shares have a priority over common stock, right? In the payment of dividends and upon liquidation also. So whenever the company has to pay the dividends, first the preferred dividends has to be paid. Then if cash remains, it should go to the equity at the discretion of the board of directors. Right? So the preferred shares have a priority over equity, but bonds or creditors, the investors who invested in the bonds of a company have the priority over preferred shares, right? Or preference shareholders. So the priority is in the first, it will go to the creditors, then preference shareholders, then it comes to equity shareholders. So when it comes to valuation of different shares, right? So if you see here, we have current yield. Whenever we talk about current yield, the denominator should always be the market price. Right? The denominator should always be the market price. Annual dividend divided by the market price of the preferred share. Right? So when preference shares do not have maturity date, the investors use the current yield. Right? So what does it mean by the preference shareholders do not have maturity? We call them as when there is no maturity, we call it as perpetual. If it is, if the maturity is not fixed, or suppose if there is indefinite life, then we call it as perpetual. When it is perpetual, the yield is the preference dividend, or how much is being paid every year divided by the market price. Suppose if there is 9% preference shares of XYZ company are selling at 72, the market price is 72, and the dividend is 9, right? The current yield is 9 by 72, which is 12.5 percentage. Suppose if it is a callable preference share, right? If the issues are callable, right? So their dividend payments cannot be expected to continue indefinitely. So what does it mean by callable is the issuer has the right to call back the preferred shares at any point in time. Issuer has the right. Right? Please remember, this is whenever we say the callable, right? It is right of the issuer to call back the preference shares at any point in time. So when the issuer issues the preference shares with a callable option, when the issuer issues the preference shares with a callable option, there is you cannot expect that the preference shares will continue forever. Right? So whenever the interest rates in the market changes and moves in favor of the issuer, he may call back the existing preference shares and go for a new issue of preference shares at a lesser dividend. Right. So that's the reason why in a callable preference shares, you should not expect the dividends to be received forever or indefinitely. So whenever the preference issue it comes with the callable option, the yield to the call date is calculated as D1 plus CP minus PI by N divided by PI plus CP by 2. So this is the average, right? So this is the average of PI and CP, and we'll see, right? So we can assume that 9 percentage 100 rupees per will be called in 3 years at rupees 108. Right. The current market price of this issue is 72, and the yield to call date, that's what we are supposed to calculate, right? Sorry. Uh, Let me just. So the amount of dividend is 9 percentage, right? 9 percentage, and the will be called in 3 years, right? So will be called in 3 years. So it is 9 percentage of 100 is 9. For 3 years, it will be 27. So dividend, the amount of dividend will be 27 plus the callable price. So you'll be knowing, generally issuers will tell you if I call back the bond after 3 years, this will be the price at which I call back. If I call the bond after 4 years, this is the price at which I call. So I know the price at which the issue is called back 108 minus the current price of the preferred stock is 72, right? Divided by 3 whole divided by 108 plus 72, that is 180. 180 divided by 2, 90. So the whole divided by 90. If we solve this, you'll get 43.13 percentage, right? So this is a very, very huge amount, right? The annual yield to 3 year call date is 43.13 percentage. Suppose if you see this, the par value of 100 that pays annual coupon of annual 12 percentage dividend, right, or 12 rupees. So because the par value is 100, the to interest the dividend rate is 12 percentage, so it's 12 rupees on 100. If the current discount rate is 15 percentage, right, so what would be the preference shares worth? So that's what, right. So we know the this is the problem what we solved. Dividend is 12, right, divided by the cost. Cost is, or the your required rate of return is 0.15. Right? It's 15 percentage, so you should take it as 0.15, which gives you uh, 80, right? So it gives you 80 rupees. So what does it mean is, if there is a preference share, right, which is ready to pay 12 percentage annual dividend, right? And if your discount or if your required rate of return is 15 percentage, or if your expected rate of return is 15 percentage, the maximum price what you should pay is 80. You should not pay more than 80, right? So if it is being traded at 82, 83, do not buy it and say that it is overvalued. If it is being traded at 75, 76, or which is below 80, then you can buy it, and because it is underpriced. That is the basic purpose of valuation. So you're supposed to find out the intrinsic value of the asset, let it be equity, fixed income, and you're supposed to compare this intrinsic value with the market value to know whether the asset is undervalued or overvalued. So if you observe this bond or debenture, generally we in India we call them as debt instruments, right? Debt instruments can be debenture or a bond, right? So the basic difference between debenture and bond is generally the debentures are issued by the corporates, and whenever a government or government backed entities like public sector undertakings issue, we call them as bonds. Right? In US, generally the difference is not like this. They call them as the corporate bonds and the government bonds. But in India, If a government or government entities issue, we call them as bonds. If a private corporates issue, then we call them as debentures. Right? So debt can be debenture or a bond. Right? So who are all the issuers, like central government or state government, government or government guaranteed bonds, the PSUs, public sector undertakings, corporates, right? And it could be the money market instruments also, like treasury bills, commercial paper, right? Certificate of deposits, right? So all these money market instruments generally have a maturity of less than a year, right? So whenever any instrument has a maturity of less than 1 year, we call them as money market instruments. A maturity of more than 1 year are termed as capital market instruments, right? So it can go up to 30 years or 40 years. It can, the issue can be with the perpetual life also, right? So the very important terms whenever we need to understand the fixed income securities, especially the bonds, right? So we need to understand certain terminology like par value, coupon rate, right? And I'll tell you this coupon rate and interest both are not same, right? So just let me. So par value is a value stated on the face of the bond, right? Generally, it will be either 100 or 1,000, right? And whenever we say par value, what does it mean is this is the face value on the bond. Par value is the face value on the bond. And most of the times, what happens is on maturity, the issuer will pay you back the par value, right? In the we call it as redemption value, right? So redemption value will be, in most cases, it will be same as the par value. Coupon rate, right? So as I mentioned, right? So coupon is the amount which you receive every year, right? Coupon is the amount. A bond carries a specific interest rate which is called the coupon rate. Right? Again, do not get confused with the interest rate and the coupon rate. Generally, we call this as coupon rate. Right? So in bonds, especially, the interest rate is your required rate of return. Right? So suppose if coupon rate is 10 percentage, if, if coupon rate is 10 percentage and the par value of the bond is 100, the amount of coupon will be 10, right? So that's what we do. And the interest rate is, if you are receiving 10 rupees every year as promised by the issuer, and the maturity of the bond is say 10 years, right? The interest rate, or especially we call it as yield in bonds, right? So the yield on a bond is the single discount rate. Yield on a bond is the single discount rate which equates the present value of the coupons to the market value or the present value of the bond, right? So when you know that you receive coupon of 10 after 1 year, 10 after second year, like this, if you are receiving say 10 coupons, so last two coupon, what happens, will be paid less the principal amount, that is 100, which is promised by the issuer, right? So if you discount all these cash flows which you are going to receive in the next 10 years, and if you discount these cash flows with a discount rate, a single discount rate, that single discount rate which equates the sum of the present values of these cash flows equal to the present value of the bond B0, right? That discount rate which equates the sum of the present values of these cash flows equal to the current market price, sorry, uh, the intrinsic value of the bond is the yield, right? So do not get confused. Coupon rate and interest rates are different in bonds. Interest rate is generally expressed as yield. The maturity period. Right? So typically bonds have a maturity period of 1 to 10 years. Sometimes they have longer maturity. It will go up to 30 years. sometimes they also, or the issuers issue the bonds with a perpetual life. And the issuer generally pays the interest at the coupon annually. But in most of the developed nations like US, right, what happens is the issuers pay the coupon semi-annually. So it is always better for us to know how to value the fixed income security, the bond, when the coupon payments received annually and the coupon payments received semi-annually, right? So what we do is first we start with the value of the bond with annual interest rate, right? Now, as I mentioned, say suppose I take the bond issue with the face value, say face value is 100, coupon rate 10 percentage, coupon rate is 10 percentage. The life of the bond, maturity of the bond is say 10 years. Say suppose if my yield is, or my expected or required rate of return on this bond is say 12 percentage. Now, what should I calculate? Given these values, I should be able to calculate the current or the intrinsic value of the bond. Right? So, the intrinsic value of the bond P, that is P, right? What we do is how much coupon we receive every year? 10 rupees. So, 10 divided by 1.12, 1.12 to the power of 1, right? Like this, we are supposed to do this for 10 times, right? Then the last payment is 10 plus your principal amount, that is 100, divided by 1.12 to the power of 10. So if you do this calculation, you will get the price of the bond, right? This price we call it as the intrinsic value of the bond, which should be compared with the market price of the bond, and then take a call whether the bond is overpriced or underpriced. If you don't want to do the calculation like this, you can also use the table values, right? Time value of money table, and you can take this, right? So you should get the same answer. So what? So if you for this bond 10 annual coupon payments of 120 each, right? And you can see here the maturity is 10, 12 percentage coupon on face value of 1000, so it is 120 rupees, right? And the life is 10 years. So what we did, 120 into present value interest factor annuity at 13 percentage. Your required rate of return is 13 percentage plus 1000 into present value interest factor 13 percentage 10 years, right? So we take this as present value interest factor annuity because every year you receive 120, right? And we don't take annuity here because the 1000 rupees is paid only once at the end of the maturity. So when you receive the same amount of money every year, right, in equal intervals of time, it should be treated as annuity. So we receive 120 rupees every year for 10 years. We take it as present value interest factor annuity. And as we receive 1000 only once in a year, only once at the end of the 10th year, we take it as the present value interest factor. So these are the values. 0.295 is the present value interest factor at 13 percentage interest rate for 10th year, and this is 5.426 is the value for present value interest factor annuity 13% and 10 years, right? So when you calculate, the price of the bond is 946.1. So suppose if the bond value, the same bond is being traded in the market at 950, right? You should not buy the bond because it is overvalued or overpriced. If it is available at 940, then you can say that the bond is underpriced and you can buy it. So that is the basic purpose why we go for valuation, right? And the same thing what we do is, if the issuer is ready to pay the coupons semi-annually, if the issuer is ready to pay coupons semi-annually, then what happens is everything remains same, but instead of receiving say 120 rupees at the end of the 1 year, you receive 60 rupees after 6 months, again 60 after another 6 months, like this. Instead of receiving 120 at the end of the first year, you receive half of that, that is 60 at the end of 6 months, 60 again at the end of the another 6 months, like that. You will have 20 payments. Earlier it was 10-year maturity and yearly payment, you have 10 payments. Now you will have 20 payments, right? So when you are doubling the period, right, because the coupon payments are made semi-annually, so 10 years will become 20, the number of periods will be 20, and the required rate of return should become half. Now if you see, right, the same formula, what did we do is, we have taken C by 2. What is this C by 2? In the earlier problem, if you take, right, C was 120, now you should take it as 60, right? 60 into present value interest factor annuity, present value interest factor annuity. Earlier the interest rate was 13 percentage, so you should take it as 6.5 percentage, because you should take half of it, 6.5 percentage, and the number of periods will become double, so you should take it as 20. So that is a change what happens when the coupon payments are semi-annual, right? If you would like to go for a yield measures, right? So one of the popular yield measures is current yield, right? As we have seen for the preferred shares, where we have taken annual dividend in the numerator. So here we will take it as annual coupon rate. So that's the difference between the current yield for the preferred shares as well as bonds, right? So when it is the preferred share, we take it as annual dividend payment, and when it is bond, we'll take it as annual coupon payment, right? So yield to maturity, right? Out of all the yield measures on the bonds, yield to maturity is widely and popularly used, right? So yield to maturity is nothing. Actually, we have seen. So if you know P0, right? What we do is, knowing the cash flows, coupon payment 1 divided by 1 plus y power 1 plus C2 by 1 plus y power 2, C3 by 1 plus y power 3, like this, C10 by 1 plus y power 3 plus RV, redemption value divided by 1 plus y power 3. So knowing the intrinsic value of the bond, knowing the coupon receipts, knowing the maturity of the bond, if you are planning to calculate y, that's what the yield to maturity, and this calculation you're supposed to solve using run and learn method. And there are certain assumptions to calculate yield. If you do not assume these are the conditions to satisfy, then whatever the yield you calculate will not be the yield to maturity. So there should not be any default. So what does it mean is, all the coupon and principal amount should be paid as per the schedule. That means if the issuer promises uh, you that I'll pay the coupon of 100 after 1 year, it should be paid. And the redemption value is say 1,000 at the end of the 10th year, it should be paid without any defaults. all the payments or all the receipts what the investors to receive must be as per the schedule. There should not be delays or there should not be any defaults. The investor has to hold the bond till maturity. So we know that it is a yield to maturity, right? So to calculate yield to maturity, you must hold the bond till maturity, right? And all the coupon payments should be reinvested immediately at the same interest rate. So suppose if your yield to maturity is 10 percentage, and if you receive 100 after first year, the same 100 must be reinvested for the remaining 9 years at 10 percentage rate. So if you delay the payments, if you do not reinvest the receipts immediately after receiving for the remaining term of the bond, then whatever the yield you get will not be the yield to maturity. Right? So just give it 2 minutes. Hello. So this is how we'll calculate the present value of the bond given the coupon's face value, which is also called as redemption value. And if you know the present value, you have to calculate yield. If you know the yield, you can calculate present value. And if you observe this equation, right, the relation between the present value and yield is inverse, right? So the yield is in the denominator, right? So we can say that denominator in opposite side. So we can say the yield is inversely related to the present value. And if we observe this graph, right? So taking price here, right? The relationship between, we call it as inverse effect, and the relation between price and yield is inverse. As say suppose if yield is here y1, if we yield is y1, the price is p1. This is the price. If yield decreases from y1 to y2, say if this is y2, the price becomes, price decreases. So if yield increases, the price decreases. This shows the inverse relationship between price and yield, right? And the relationship between price and time, right? Now if you see this, we are talking about a par value bond with a yield to maturity as 13 percentage, right? And if we have two bonds, right, the one bond is trading at a premium to the current price, the other bond is trading at a discount, right? So this bond is at a premium and this bond is at a discount. So as the time progresses, as this is the maturity, this is the maturity, and as the time progresses, the bond which is trading at premium, right, the price comes down and becomes the par value, and the bond which has the price less than, or the bond which is trading at discount, the price slowly increases and it reaches the par value, and it should be same as the par value on the maturity. Otherwise, there will be arbitrage opportunities which makes the price to be equal, right? And this relationship is very important. If, right, if coupon rate is higher, coupon rate greater than yield, right? So all the investors would like to hold the bonds with a higher coupon rates, right? So when the coupon rate is greater than yield, right, the price of the bond will be greater than par. Simply, you should remember like this: higher the coupon rate, higher will be the price greater than par value. If these two are equal, coupon rate and yield equal, then the price of the bond will be same as the par value. And if the coupon rate is less than yield, then the price of the bond will be less than the par value. So the reason why this relationship holds good, because given two different bonds, people would like to invest or would like to buy the bonds with a higher coupon rate. So as people would like to buy the bonds with higher coupon rates, generally the price of the bond increases, and it may be increase and more than the par value of the bond. So that's the reason why higher the coupon rate than the yield, higher will be the price of the bond than the par value. So the last concept is duration of the bond, and what duration tells us is it tells us the number of years taken by the bond to get back your initial investment. Right? Suppose if I invest in a 10-year bond, if I invest in a 10-year bond, which is a coupon paying, then the duration of the bond will not be 10. It may be around 7.58 years, depends on the amount of coupon what to receive. So the duration of a bond, which was calculated first by Macaulay, and we call it as Macaulay duration, right? And this duration is the amount of time it is taken to get back your initial investment. Otherwise, it is also the measure of interest rate risk, right? So higher the duration, generally what we say is higher the interest rate risk. Say suppose if the duration calculated and you got the answer is 7. So what does it mean is for every 1% change in the yield, the price of the bond changes by 7%. So that's how the duration is interpreted, and just let me show you how to calculate duration. Right. So this is a 4-year bond with a cash flow or a coupon of 70, 70, and 70. And at the end of the 4th year, you receive 1070 because 70 is the coupon and 1000 is the principal amount, right? So 1 by 1 plus r power t, which is 0.943, and right. So t is 1 here. So 6%, yield is 6%. So 1 by 1.06 to the power of 1, which gives you 0.943, and this is 1 by 1.06 to the power of 2, which gives 0.890, right? So then what did I do? This is called as present value interest factor, right? This is present value interest factor. So 0.943 multiplied by 70 gives you 66.01, right? And this is Ct divided by 1 plus r power t divided by P0, right? So you know Ct is 70 divided by 0.943, and which is divided by P0 gives you 0.06, right? Multiplied by time period again. So this is 1. And here the time is 2, time is 3, time is 4. And duration is 3.6310, right? So what does it mean? Though the maturity of the bond is 4 years, the duration is 3.63, right? And if you see the bond B with 8% coupon rate, the duration is 3.59. So what this tells us is higher the coupon rate, it takes less time to receive initial investment, right? So as it is less time to take initial investment, that reflects in the duration, right? So higher the coupon rate, right? Higher will be the, sorry, lower will be the duration, right? So see here, earlier the coupon rate was 7% and it took 3.63 years, and when the coupon rate increased to 8%, the duration of the bond decreased to 3.59 years, right? So higher the coupon rate, lesser the duration, right? So that's what we get it from the valuation of the bond or valuation of the fixed income securities, right? And basic purpose of valuation is to determine the intrinsic value of the any asset, let it be equity, fixed income, or right. In fixed income, again, it can be a preference share or uh, bonds. We calculate the intrinsic value of the bond or the intrinsic value of the asset. We compare this intrinsic value with the market value. Then we take a decision to know whether the asset is underpriced or overpriced. Right. So I close the session here. So if you have any questions, please let me know.